All right. So, as a small business owner, you probably heard of a line of credit for your business, right? You might even have one. But have you ever heard of accounts receivable financing? This is something that's not as commonly known out there. And I want to just quick explain it to people so they have an idea what it is. So, essentially, if you're a business and your customer is another business, so you're doing B2B type work, not direct to consumer, you may be eligible for accounts receivable financing. And the way it typically works is there's a third party that's willing to buy that debt off you, those receivables off you. So, say for simple numbers, you have $100,000 at the end of the month with accounts receivable, right? Now, these may be 30, 60, 90-day terms, whatever terms you might have. So, but you might need the money up front, right? You have payroll you need to cover. You might have some other debt coverage that you need to, pay down or something or anything else. Maybe there's an expansion, inventory, whatever the case, doesn't really matter. But it would benefit you to have the cash now and not have to chase down all these people to get money that for services that you've already performed, right? So you could sell this off to a third party lender, and what they'll typically do is give you about 80% of it. So, in an instance where you have $100,000 at the end of the month owed to you as receivables, you can get $80,000 upfront right now that you can use for whatever you want. And the other great thing about it is that that debt now, the third party lender now owns. They're the ones that are going to chase it down. They're the ones that are going to try to track down the money that's owed to you, and you can just focus on your business. So you might be thinking like, well, what about the other 20%? Is that what they get to keep? Are those the fees? No, what happens is that 20% is built in there as a buffer. And 20% is roughly like it might be 30%. They might lend 70%, they might lend 85%, whatever. I'm just using 80 because it's a pretty common amount used. They'll give you 80% of what's owed to you up front. And they'll start tracking down the other businesses that owe you money. And they might be, 30, 60, 90 days to receive the money back. You'll end up owing just the interest. There'll be an interest agreement between you and that third party lender for taking that money basically as an advance. And like I said, they're going to track it down. They're going to do everything. Once they track down the money, you can get the rest of that money brought back to you minus just the fees for whatever you borrowed up front. Now, typically, like with a small business, lenders like to work with people that are doing at least $50,000 a month, typically in receivables from other B2B type work. So if you're in that range or above that, this might be a great option for you to add on. Even if you already have a line of credit, this might be an additional thing that you can add on to that. Trying to think if there's anything else. That's pretty much the biggest stuff there. So if you got any questions, though, reach out, ask me. I'm happy to share. This is stuff that we do oftentimes with those kind of small to medium sized businesses that are just looking for that cash up front right now. Again, you only have to tap into it if you want it. You don't have to take the full 80% leverage. You can leverage less than that if you like. It's a very, 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 very flexible, very, very, very flexible way for you to get access to cash that's already owed to you for services already rendered. All right. Hope it helps. All right. Look forward to talking to you on this next one. Until then, stay profitable. Take care.